Hello everyone. In this session, we will dive into the present value of an annuity. It's very important that you understand how to compute the present value of a single amount, a topic that we covered in the prior recordings. It's also helpful to understand how to compute the future value of an annuity, because when we computed the future value of an annuity, we explained what is an annuity. Anyway, what is an annuity? Well, it's a series of payments or receipts of money at the same interval, the same amount of money at the same interval. In this session, we will focus on figuring out the present value of these payments. This is an extremely important concept in finance and accounting, because you will see this concept again and again in your courses, whether you are computing the present value of a bond, a note, pension obligation, the value of a stock, net present value. It's limitless. So it's very important that you understand this topic inside out. So the prerequisite to this recording is knowing the present value of a single amount, knowing generally how time value works. At the end of this recording, we will work a multiple choice question to reinforce your understanding of the concept. Let's go ahead and dive into this important concept. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. Let us start by looking at some practical application of the present value of annuity. One application is loan payments. The purpose here, when you would use the present value, is to find or to understand the amount borrowed, the loan principal. So as a bank or as a banker, here's what you do. When you lend money, you expect to be paid in the future a series of payments, like 5 payments. 10,000 each, 10,000 each, 10,000 each, 5 payments. What you will do to find the present value of the loan today, you will find the present value of this annuity. So this is one application of it. Matter of fact, in accounting, you have to know this. If you have a series of payments into the future, which is any sort of a liability that you have to pay into the future, like a loan or a lease or a bond, what you will do is you discount those present value you will discount those future payments into the present value. So it's an annuity, you will use the present value of an annuity. A loan is an example. Another bond is another example. When you have a bond, you calculate the present value of the future interest payment and the principal payment. Now in the next session, I would look at a bond specifically to illustrate this concept. But this concept don't applies to bonds alone, because as you can see, I said bonds or any investment. Now if this is not an understatement if I said that your finance degree, all your finance degree is based on this concept of the present value of money, the present value of money. So when you want to value any investment, so when you make an investment, what is the investment? An investment is looking into the future and projecting different cash flows. Now, if those cash flows are the same, we call them an annuity and we discount them. But those cash flows each could be different. Nevertheless, what you will do, you will discount them to the present value and you will find the present value, and this will be the price of the investment, which is the price of the stock, which we'll talk about this later on when we value stock. That's another usage of the present value of money. Now, if it's an annuity, it's easier to compute. Why? Because it's the same amount. However, we're going to start today by looking at discounting, not an annuity, just to kind of go back to the purpose of discounting. Another usage of annuity, which is there's unlimited usage, I'm just giving you those examples. Retirement planning. Determine how much you need to invest today to achieve a fixed income during retirement. And I'm sure you heard this saying, when people retire, they purchase an annuity. So when you retire, here's what you do. You would sell all your asset, all your stocks, investments, everything that you have, and you purchase an annuity. What is an annuity? An annuity, again, a series of payments that you will be receiving. And let's assume you would expect to live 25 years after your retirement. You want an annuity that's going to pay you per year, for example, $80,000 per year, $80,000 per year, $80,000 per year. So you would go to these insurance companies or investment companies and you tell them, I want to buy an annuity. I want to buy an annuity that's going to pay me $80,000 for the next 25 years every year. And they would say, okay, based on a certain percentage, they discount this amount and they will tell you have to pay, for example, $380,000 or whatever the amount happens to be. So today you will pay, so that's why you sold all your investment to do what? To pay for this annuity, so you will get $80,000 in future payments. So you computed the present value of that annuity. Again, if you look at my investment course or finance course, we'll talk about this a little bit more. But those are some practical usage. Now let's start with a simple example to just kind of go back and refresh our skills to compute the present value. Imagine you need $1,000 a year from now and $2,000 in 2 years. So this is what we're looking at here. You are looking at 1 year, you will need to have $1,000. And in year 2, you need $2,000. The interest rate that you can earn is 9%. How much do you need to pay today? So how much you will need to invest today to get this amount? Now, bear in mind, this is not an annuity. This is different cash flow. So how would you find out how much you will need to invest today so you can withdraw $1,000, then another $2,000? What you will do is you find the present value of those two payments. Well, the present value, how do you find the present value? We'll take 1,000 divide by 1.09 raised to the 4th power, or we can go to the table, which I will show you next, which you saw this. You will take $1,000 times the present value factor, n equal to 1, I equal to 9%, which we will see in a moment, and I can tell you it's 0.917, which, that's the factor. But also you can divide 1,000 by, using the formula, 1.09 raised to the 1st power. So to get the $1,000, you need to invest today $917.43. For the $2,000, you will take the $2,000 divided by 1.09 raised to the 2nd power, because you need this money 2 years from now, and you will need to have $1,683.36. Obviously, there's a present value factor. I will show you on the tables later. What you will do, you will add those two figures, and you will need to have $2,600 today, so you can withdraw $1,000 1 year from now and $2,000 2 years from now. And today you need to make an investment of $2,600. I'm going to round it in $1. You make the investment today. This is negative. You will get $1,000 1 year from now, another $2,000 2 years from now, because this money will be invested at 9%. So the total is what you would invest today to meet the amount of that you need. So this is a simple present value. This is not an annuity. This is just kind of warm you up. Basically, a review of the present value of $1. It means a single payment. Let's take a look at another investment. Let's assume you are considering an investment that pays $1,000 at the end of each of the 5 years with an annual return of 6%. What is the investment worth today? So someone came to you and said, look, I'm willing to give you $1,000 at the end of the first year for the next 5 years. So 1,000, 1,000, 1,000, 1,000. On the timeline, it would look something like this. Each X is 1,000. 1, 2, 3, 4, 5. Each X is 1,000. how much will you pay today for this investment, assuming you want to earn 6%. Now, where's this annual return? This is how much you want to earn. So when you discount anything, you will discount anything on the rate of return that you want to earn. So it happens to be 6%. How? That's your risk tolerance, 6%. How do we come up with this 6%? There are many factors. You don't have to worry about this now. Just know you need to earn a certain return. That's acceptable to you. I want to earn 6%. So you will discount those payments. So let's do it first the manual way. Each 1,000 separately. Remember, you're going to get $1,000 the first year. Now what you do, you will take this $1,000 and you will discount it to the present value. You'll take 1,000 divided by 1.06 raised to the first power. It will equal $943.40. So for the first $1,000, you will pay this much. The present value factor you're going to see on the tables is 0.9433. So you will take 1,000 times this factor, 0.9433. The second $1,000, so a year to you're going to get another $1,000. This $1,000, you will take it divided by 1.06 raised to the second power, or you can take $1,000 divided by the time value factor from the table, 0.89, which I will show you the table. And this second $1,000, you only have to pay for it $890. Why? Because the second $1,000, it's going to sit, the money that you invest today will sit for 2 years. Therefore, you would need to pay less. The third $1,000, you will discount it at 1.06 raised to the third power, which will come to be $839.62, say $840. Or the factor 0.84, you will take rounded. 1,000 times 0.84 will get us $840. So the third $1,000, this one, you only pay for it $840. Now the future money, because it's taken you longer to get the money, you'll have to pay less, because that money, whatever you invest today, will grow more because you're giving it more time to accumulate interest. Then the fourth payment, this fourth payment of $1,000, get discounted at 6% raised to the fourth power, or the factor from the table, 0.792. Now if you're wondering where these factors are coming from, I'm going to show you the table in a moment. Then the last one, 1,000, and this $1,000, this you will only need to pay for at $749 using the same computation. The factor is 0.747. Let's add them up. And if we add them up, they will add up to be, you have to pay today $4,212.37. If you pay this much, you'll be able to withdraw $1,000 and you let it sit there. I'm gonna prove it to you. You can withdraw $1,000 for the next 5 years. Now were these 0.4333, 0.89, 0.84, 0.792, 0.747? If we go to the time value table, specifically the present value of a single payment, keep that in mind. We have many tables, so don't confuse the tables. We're treating this problem, this is an annuity, but we're treating it as a present value to basically reinforce the present value computation before we move to the annuity. So this is the present value table of one, the present value of a single payment. And here, remember, we're dealing with an interest rate of 6%. So where all these numbers are coming from? So if we're looking at 6%, this is the one period, this is the 0.94 factor, this is the second period, 0.89, the third period correspond with 8.4, fourth period and fifth period. So those are present value factor. Now, if I take those present value factor, all of them, and I add them up, they would come up with 4.2123. So if I add them up, they add up to this. We call this factor the present value of an ordinary annuity. What does that mean? It means if you know the present value of an ordinary annuity, you can take the $1,000 multiplied by this factor, 0.424123, and come up with $4,212.37 rounding. It means I do have a table that I can use. So by investing, let's reinforce this before we proceed to the table. By investing $4,212.36, you would earn 6% annually and withdraw $1,000 for the next 5 years. Now, if you don't believe me, let me prove it to you. So today you put away $4,212. This money will grow at 6%. So if you take this money times 1.06 1.06, which is the original money, you multiply it by 1.06, it's going to give you 4,465. Remember, at the end of the year, you take out 1,000. What's left is 3,456. You withdrew 1,000. Now, you will keep this money in the bank. Again, you multiply it by 1.06. Why 1.06? Because you need to get your money plus 6%. This 3,465 will grow to be 3,673. Then you take out 1,000. What you're left is 2,673. You keep this money and you let it grow at 1.06. It will grow to 2,833. Then you take out 1,000. What's left is 1,833. You keep this money. You let it grow at 1.06, which is 6%. It will grow to be 1,943. You take out 1,000. What's left is 943. At the beginning of year 4, you have 943. You multiply it by 1.06. It will be 1,000. You'll take out 1,000, and your investment did indeed pay you $1,000 for the next 5 years. So this individual invested 4,212. That money grew at 6%, and every year they were able to withdraw 1,000, and they met their objective. Now, going through this computation, this will get tedious. So what happened is this. You could use either a calculator, or you can go to a new table called the present value of ordinary annuity table. Again, this is how you find the present value of an annuity using the table rather than using formula or computation. How do you find this out? Well, you would say investment is 6%, and it's invested, how long is this? This is 5 years. So 6%, 5 years, you go to the corresponding, and it's 4.212. So if you take 10,000 times the factor, this is called the present value annuity factor, ordinary annuity factor, will give us the payment, the present value, 4,212. So rather than discounting each payment separately, since this is an annuity, you can go to the present value of ordinary annuity. Now remember, this is the present value of an ordinary annuity table. Don't confuse this with the present value of an annuity of a single payment. What we did first, we use a single payment to illustrate the computation step by step. So what I did here is I went and I discounted each 1,000 separately. I don't have to do this. If it's an annuity, I can jump right away to the annuity table and get the answer. But I want you to understand how we came up with the annuity table. Now, since we have ordinary annuity, guess what else we have? We have an annuity due. Just like we had a future value of an just like we had the future value of an ordinary annuity, and we have the future value of an annuity due, we have the present value of an ordinary annuity, and we have the present value of an annuity due. What is an annuity due? Annuity due is when the first payment you make is today. When the first payment you make is today. Just like with the future value of an annuity, the first payment you would receive is today. So how much you would pay for an investment that promised to pay you $10,000 annually for 5 years at 5% with the payment made at the beginning of the year. Here what we're asking is this. How much you will pay for this payment? How much you'll pay, for this investment that's going to pay you $10,000, $10,000, $10,000, $10,000, and $10,000. Notice the first payment that they're going to give you, the $10,000, is today. So you'll get the first payment today. Now, without even performing any computation, can you think how you will do this? If I stop right here, can you solve this problem? I hope you can. What you will do is this. Very simple. You will treat those 4 payments as an annuity, as ordinary annuity, right? As annuity ordinary, plus you add the 10,000. You add this 10,000 because this first 10,000 don't earn any interest because you just got it here. So this is what an annuity due is, but we're going to show you the computation step by step. So the payment are, you get 10,000 at the beginning of the first year, 10,000 at the beginning of the second year. Notice it's at the beginning, not at the end. This is what it looks like. Now, what we'll do is we'll treat it as a regular annuity. So So the first 1,000 you don't discount because the first 10,000 doesn't get a discount. If you're getting $10,000 today, it's worth $10,000 today, because this is what we talked about when we talked about the time value of money. $1 today is worth $1 today. If you're getting that $10,000 today, you don't discount that $10,000. Then you start to discount. We're going to do it the long way, using the present value of a single payment. The second 10,000 will be discounted at 1 year from now at 5%. We're doing this, n equal to 1, I equal to 5%. The second one is n equal to 2, I equal to 5%. And we're using which table? The present value of a single payment of $1. So if we discount those payments separately, they add up to be $45,459. Let's make it $45,460 rounding. $45,460. Do we have to do this? No. Here's what you can do. If you add up all these factors, they add up to 4.546. If you add them up, and guess what? There's a formula to come up with this factor immediately. There's a table. There's a table for the present value of an annuity due. If you are not giving the table, that's fine. All what you have to do is find the ordinary annuity and multiply it by, so the present value of an annuity due, the formula is the present value of an ordinary annuity times 1 plus I. That's all you have to do. So you would look at the present value of an ordinary annuity, n equal to 5 and 5%. So let's go back to that table. So if you go back to the table of the present value of an ordinary annuity, hold on a second. This is an ordinary annuity, but I am looking for an annuity due. Sometimes you're not giving this information in your textbook or on the exam. Sometimes on the exam you are expected to find the annuity due without giving you the tables. That's fine. You go and you would look at the ordinary annuity table. 5 period, let me change the color. Let me change it to red. 5 periods and 5%, and it's 4.392. Then you multiply it by whatever interest rate you are using. You are using 1.05, and you will find the factor of the annuity due. So let's go back here. So how will you find the annuity due? First, you will find the ordinary annuity, 4.329 or 4.323. Then you will take this factor, you multiply it by 1.05 by the interest rate. So the annuity due factor is 4.546. Where did we see this? 4.546? 4.546. We saw it right here when we computed this manually year by year. We don't have to do it year by year. In the real world, you use Excel. Then you will take the amount times the factor, 45,460. That's the answer. Now, if you are giving the present value of an annuity due, now once again, some textbook don't give you this table. Some finance or accounting textbook that they don't. But they expect you to know how to convert. If you are giving the table, great. If you are giving the table, notice 5 period, 5%, 5 period, the factor is 4.546. You don't have to do any computation. It's giving. Now, how do you know the present value of an annuity due? It's an annuity due table. Notice for year one, the factor is 1. Because when you get the first payment, or when you make the first payment, if it's a due, there's no time value. Multiply the answer by 1. So just kind of a hint. If you're like, how do I know this is an annuity due table? The first year will equal to 1. You don't discount the first year. Therefore, if you have an annuity due table, you are asked for 10,000 to find the present value of this. You will take the 10,000 multiplied by 4.564. Now, I'm not going to prove it to you, but you can go ahead, put this money, take 10,000, keep it at 5%, and start to take 10,000 and keep it at 5%. Obviously, I'm sure you can prove it to yourself if you would like to, but I'm not going to do it for you. Maybe something you want to do. Now, another way when you are using the present value table, sometimes you are giving the problem where you have to find the interest rate in a problem. Remember, what you are dealing with here is this. You are dealing with the payment, and you are dealing with the interest rate in a period. So the present value of an annuity, equal to the payment times the present value annuity factor. So if you want the present value of annuity, you will take the payment times the present value factor. So let's assume you own $528.77 on your Visa card. This is how much you own the credit card company. So you can pay them today this amount. So this is the present value of your loan. $528.77, because if you write them a check today, they will accept $528.77 and they would reduce your amount down to zero. The lender offer you 12 equal payments if $50 to pay off the account. So if you pay $50 12 times, they would say, we'll pay off your balance. But they did not tell you what interest rate they're charging you. Can we find out the interest rate? Yes. If we know the present value of the annuity, it's $528.77. The present value of the annuity equal to the payment times some factor. We know the payment. All what we need is to find out the present value of a factor, of the ordinary annuity factor. Well, we can solve this formula. If we solve for the present value of the ordinary factor, we'll divide both sides by 527 divided by 50. We divide both sides by 50, and we find the present value annuity factor is 10.5753. This is the factor. Now, we know the period we are giving is 12, so we're going to go down to the table here, 12 periods, and we're going to go across to the closest thing to 10.573. If we go across, we notice 10.575 is the same basically as 10.573. So they're charging you 2% interest on this loan. They're charging you 2% interest, but remember, they're charging you this interest is monthly. This interest is monthly. Why? Because your payment is monthly, so 2% interest. So your monthly rate is 2% interest. Well, I don't believe it. Well, let me prove it to you. Well, here we go. If you have an amount of $529, what's going to happen? The first month, they're going to charge you another 2%, and your balance will become, at the end of the month, $539.35. Then you're going to pay $50. Remember, every month you pay $50. The remaining balance is $489.35. Month 2, again, you're going to have this balance. The credit card company will charge you 2%. Now you're going to take this amount, $489 times 1.02 to get to the 2%. Your balance will be $499.13. You pay $50. What's left is $449.13. Now this remaining balance, you'll be charged 2% on it, and the balance will become $458.11. Then you pay $50. Then notice what's happening. The balance is dropping. Again, it goes up a little because they charge you 2% every month. Then you pay more. Then the balance keeps dropping, and if you keep up with this computation for 12 payments, the last month, $49 times 12 times 2%, your balance will be $50. You pay the $50 and your balance is zero. I just proved to you that if you are charged 2% interest on this balance and they promise to accept $50 payment, if you pay it off within 12 months, indeed, they're charging you $2. So not $2. They're charging you 2% on this loan because they don't tell you. They told you, look, we'll accept $50 payment for the next 12 months and we'll wipe out your balance. But they did not tell you the interest. You could figure out the interest. Sometimes you have to compute the payment in an annuity. What does it look like? Let's assume Marge and Homer, yes, Marge and Homer Simpson, have saved $36,000 to finance Lisa's 4 years of education in a local bank earning 4%. What amount can Lisa withdraw every 6 months during her 4-year college? So here what we're looking at how much is the payment. Remember, what's the formula? The formula is the payment times the present value factor equal to the present value of the ordinary annuity. So let's complete what we have. We have the present value of an ordinary annuity, which is $36,000. We don't know the payment. This is what we're looking at. We know the factor. How did we know the factor? Now we have to be very careful here, okay? How do we know the factor? The factor is this. The period here, it's 4 year, but it's semi-annually. Therefore, the period is 8. Now, the 4%, it's semi-annually. Therefore, the 4% is 2%. You have to be careful. Remember when we talked about simple interest and compound interest. Therefore, the factor, the present value annuity factor, is 7.325. So the 36 payment equal to some payment times this factor. Now, obviously, we can solve for the payment. So if we divide both sides by 7.3225, we're going to get the payment when we divide those two, 36,000 divided by 7.3255. We see that the payment is approximately $4,914.35. Simply put, what I am saying is Marge and Homer, they can put this money today at this bank. This bank would earn 4%, and every 6 months, Lisa can withdraw $4,914. If you don't believe me, let me prove it to you. Let me show you the computation. So here, this is the same thing that's on the previous slide. We found the payment. Now this is a table. Now I made a mistake here. Not year one. Those are period, because it's 4 years. So this is period one, not year one. Remember, let me just write period properly. Because remember, this is a 4-year, it's a period one. Every period is 6 months. So notice, Marsh and Homer invested this money at the bank at $36,000, and here the interest is misspelled. Interest. So this money will grow at 2%. And for the first 6 months, when Lisa walked into that bank 6 months later, the bank will have $36,720. Lisa to withdraw $4,914, and the balance that stays at the bank is $31,805.65. This balance will stay at the bank, will earn another 2%. 6 months later, Lisa will come back and she will check the balance, and the balance is $32,441.76. She can withdraw $4,914.35, and the remaining balance is $27. Another 6 months later, this money will stay at the bank, will grow at 2%, and the balance will become $28,077. She will withdraw $4,914. And you guys guessed what's going to happen. By year 4, the last 6 months, the balance will be $4,818. It will grow by 2%, and the balance, when Lisa walked into the bank, the balance will be $4,914.37. She will withdraw the full balance. I just kept the payment the same, but she will withdraw the 37. You know, Lisa, how Lisa is, right? And the balance will be 0. So notice I just proved it to you that the computation is correct. Now, a few things you want to know about when computing the time value of money, specifically the present value of an amount. This is very important. The first thing is, if you're using the timeline, make sure you are drawing the timeline. The years and payments helps to keep things organized. So if it's a year, make sure it's a year. If it's a half a year, break it down. If it's 4 times, break the year into 4. So make sure you are drawing the timeline properly. The other thing is, double check the discount rate. When you are discounting, when you are using the table, always use, now don't worry about why for now, make sure you are using the discount rate. Now, sometimes the discount rate is, you are told this is the discount rate. Sometimes this discount rate is called the market rate. It might be called something else too, but for now you could live with the discount or the market rate. This is the rate that you will use to discount the payment, to find the present value of the payment. Make sure you're using the proper discount rate, and make sure you are using also the proper tables if you're using the tables, because if you're using the wrong table, then it's all wrong. And the third thing you want to know is, understand the problem. Am I giving an ordinary annuity, or am I giving an annuity due? When does the payment start or end? That could make a difference. Am I dealing with a ordinary annuity, or am I dealing with an annuity due? That's very important. Now let's take a look at a multiple choice question from farhatlectures.com. Which of the following best describe the present value of an ordinary annuity? So you have 4 options. Which one is the present value of an ordinary annuity? Let's try to kind of eliminate, let's read the choices and try to eliminate the obvious answers. The value of equal payments received at the beginning of each period. Well, now, if it's ordinary annuity, any payment received, it cannot be at the beginning, because the beginning of the period has to do with annuity due. I will take A out. The value of equal payment received at the end of each period discounted till today. Yeah, this sounds like a present value of an ordinary annuity. Definitely B is better than A. Let's look at C. The future value of equal payment compounded at the end of each period. First of all, this C is talking about the future value, and the question is about the present value. This is an easy elimination. D, the total sum of all payments received without considering the time value of money. Hold on a second. The present value is all about the time value of money. This is also an easy elimination. As we predicted, B is the correct answer, because this is the definition, an important, extremely important definition. So every time you have any sort of payment or receipts for that matter in accounting, and this is important for accounting and finance, what you do is you discount them using a discount rate, an interest rate to the present value. So you find the present value. And believe it or not, when we record any liability, liabilities are recorded at their present value. Even when we record any asset, let's assume we're looking at a notes receivable or an accounts receivable. If we're receiving money into the future, we discount it at the present, assuming it's longer than a year, to find its present value. And the present value is an extremely important concept in accounting. What should you do now? You want to go to Farhat Lectures, look at additional resources, multiple choice, true, false, lectures, whether you are studying for your CPA exam, CMA exam, finance or accounting courses. Invest in yourself and stay safe.